Slide number 1. Let's explore how money grows by understanding the financial sector, its participants and products, how markets evolve over time, what compound interest means, how return and volatility are defined and calculated, and finally, how a portfolio should be managed throughout its life. The main purpose of this session is to help you realize the opportunities that come from investing your savings, and the risks that accompany those investments. By the end of this presentation, you should have an idea of how the financial sector is structured and what the main financial products are, how to react to market movements, and which factors influence your investments. The goal is not to make you an investment expert, but to help you connect the key concepts that shape your financial decisions. Investment and portfolio management is a profession, and as such, theoretical knowledge and practical experience are needed. Don't expect to master it just from this discussion. Start investing, and you will have much more sensitivity and insight that only real experience can bring. Take note of your doubts in each slide and we can have a discussion later. Slide number 2. The document is divided into 5 connected subjects, beginning with a challenge in the introduction that I invite you to take. Slide number 4. Imagine it's a sunny day, and you are walking through a park when a swindler approaches you to offer to choose between 2 prizes. Receive €1 million immediately. Or receive 1 cent today and wait 30 days to receive the total amount of doubling the daily balance per day. So, which one would you choose? Send me your pick via WhatsApp. Slide number 5. How the second offer evolves. After the first week, the amount slightly exceeds €1 and only €10 after 10 days. Halfway through, day 15, and still under €330. Wow, that's slow. Another chance, want to change your bet? By day 20 it's just €10,500. At day 25, the amount reaches only about €335,000. No way. What do you think? You will get more than €1 million today. Over €1 million in the day 27. Indeed €1.34 million. And finally boom. In 30 days you would obtain more than €10 million. Slide number 6. In an economy we can distinguish among different sectors such as the public, industrial, services, agricultural and livestock. The financial sector can be considered part of the service sector. However, it plays a much more vital role. The financial sector could be compared to the circulatory system in the human body, keeping everything else functioning. Just as blood carries oxygen and nutrients to the organs, the financial sector channels money from those who save money to those who need funding for investment or consumption. In this section, we'll review the main components and roles of the financial sector and explore the key services and financial products that make this connection possible. Slide number 7. The components of the financial sector are all the elements that interact within a framework of laws, regulations and governance established by governments and supervisory authorities to ensure its proper functioning. These elements include a wide range of institutions and entities of an economy, from governments and companies to banks, insurers, brokers, or intermediaries, and individuals, investors. The interactions among the participants are carried out mainly through standardized contracts, which facilitated fast and efficient transactions. Some products are designed primarily for companies while others are available for not only by companies but also for governments and individuals. Financial products can be based on the real economy such as deposits, credits, or shares, or to other products, such as derivatives or funds. Some of these financial products are trade in regulated markets subject membership and oversight, while others are offered directly by financial institutions, for example savings accounts, credits, insurance or investment funds. The financial sector plays a fundamental role in the economy. Its most essential is the intermediation between different participants and channeling funds from savers and borrowers. It also acts as an economic accelerator, allowing projects to move forward immediately rather than waiting years to gather the necessary funds in many cases, making possible what would otherwise be impossible. When financial sector functions well, it supports smooth and stable the economic growth. When it fails, it can slow down or even disrupt the real economy. Finally, the financial sector provides the infrastructure and tools that allow economic agents to carry out their activities, enabling payments, financing, investment, and the movement of money throughout the system. Slide number 8. In general terms, there are 4 main participants in the financial sector, and they all interact closely with one another. Governments play a dual role. They define the rules and ensure they are respected, but they also rely on the financial sector to fund their budgets. Closely linked to governments, though theoretically independent, are the central banks, such as the ECB in Europe, the Bank of England in the UK, and the Federal Reserve in the US. They oversee the economy and manage the money supply, usually through open market operations, which involve buying or selling securities. These actions influence short-term interest rates, which in turn affect long-term rates and overall economic activity. Banks are key participants. On one side, they interact with central banks, on the other, with the public, both companies and individuals. Today, some traditional banking services are also offered by specialized institutions, such as payment providers or investment firms. Still, one of the bank's main roles remains to collect savings from the public and grant credit to borrowers. Companies use banking services for payments, investments, and managing excess cash, but also to obtain financing. They may also raise funds directly from financial markets by issuing bonds or selling shares to investors. Finally, individuals rely on banks for their daily payments, savings, and investments, as well as for loans to buy goods or property. Both individuals and companies can also access services from financial intermediaries, such as investment firms, advisors, or payment providers. Slide number 9. Here we present a summary of the most relevant characteristics of 4 main financial product plus a hybrid product. This slide is a bit dense, but don't worry, is the only one like this. The rest are easier to digest. Banking products are not considered investment product in the strict sense. They are financial services, because we need them, and the other participant in the market too, to carry out the daily economic-related activities. Banking products could be divided into three categories: pure services, such as payment systems, transfers, plastic cards, or guarantees, when the bank ensures to paying to a third party in case the client can't comply with such payment; deposits products, such as cash accounts, savings accounts and term deposits; and financing products, including credit lines where funds can be withdrawn as needed to finance expenses up to a certain limit and repaid at any time before maturity, including interests, or loans, where a fixed amount is borrowed up front, to carry out an investment, and repaid periodically with payments of principal and interests over time. A very important note here: take debt only when it helps you to build wealth, for example to buy a durable physical asset or improving your skills. Do not take debt for expenses or you will lose your freedom. Do not take debt to invest. In case market crash you will lose not only your capital but also the debt. This is called leverage risk. We present here the more basic investment products, which also are the basis for other more complex. Bonds represent debt issued by companies or governments in the form of tradable security. The initial owner of the security is indeed who lends money to the issuer, and later that bond could be sold to others who accept the repayment risk of being repaid by the debtor in exchange for the interest. The principal is usually paid back at maturity, but some bonds pay it back periodically or allow the debtor to repay it at any time, callable bonds. Similarly, interests can be explicit and be paid periodically, coupons, the most usual, or at maturity, or they can be considered implicitly. The debtor received, let's say 90% of principal and pay back 100%, so 10% of interests. Before investing in bonds, it's very important to understand how robust is the debtor, its creditworthiness, to pay back the debt. Also is crucial to be aware of the interest rates risk. When bonds are traded, their value are impacted by the current market interests for similar debtors. For instance, if a bond is paying 5% for 5 years, but new bonds for similar debtor are paying 6%, the bond will have to be sold below its principal value. If market rates are lower than the bond's interest rate, the bond's value will increase. Shares, also called stocks, represents the ownership of a company and other portions in which the capital of a company is divided. Companies' partners provide with capital to carry out the initial activities and to support the credibility of the company. To allow partners trade their part of the capital, companies' capital is divided in portions that are the shares. Shares may have different rights, affecting their value. These different rights are assigned to target different partners when a company is looking for capital. Shares value reflects company's value, that is, the value of its asset minus the value of its liabilities plus the investor's expectations about the company's future. The company is not obligated to repay the capital contributed by investors, unlike bonds, where the company is obligated. Funds are called investment or mutual funds, being the denomination for collective investment vehicles managed by a professional investment manager. Those vehicles could have legal personalities like SICAVs, investment companies with variable capital, and other do not have like mutual or investment funds. In case of mutual funds, the legal personality is provided by the management company. This means the fund itself cannot sue or be sued or enter into contracts. SICAVs are usually addressed to individual investors or restricted groups of investors, while investment funds target a broader public. Around a fund there are different stakeholders that ensure the good evolvement of the fund and protect the investors. Funds' assets are managed by a professional, which follows the investment policy of fund, so the investors could select those that are more appropriated to their objectives and risk profiles. Funds can be classified by their legal structure, by their invest policy, their assets, industrial sectors, investments, geographic location, etc. Finally, the fourth financial product included here are indexes. Someone could argue that they are not really financial products, which I agree, but they are a reference of the market they are representing and are widely used by investors to benchmark the performance and risk of their portfolios. If a portfolio cannot beat the performance of an index without taking on significantly more risk, then it is better to construct the portfolio following the structure of the index. The main characteristics of an index are the objective, what asset market or sector will represent, the inclusion criteria, the rules to define which securities are eligible for inclusion, the weighting methodology, that is, how much influence each component has on the index's final value, market cap weighted, price weighted, equal weighted, other weighting methods. The entity publishing the index will have to collect the underlying data and calculate the index and rebalance and maintain it to ensure it continues representing the objective for which it was created. Slide number 10. In this section we will review the behavior of markets over the time, especially the S&P 500. This will help us to take a first contact with markets movements and to begin to define an investment strategy. Slide number 11. The trade-off between return and risk is intrinsic to investing, and in general, achieving higher returns requires assuming greater risk. However, this does not imply the opposite is true. Assuming greater risk doesn't always mean achieving greater returns. Another generally accepted rule is that the bond market is less volatile, less risky, and offer lower returns than the stock market, although there may be times when this maxim does not hold true. The figures mentioned in the text refer to annual averages for the period from September 2009 to September 2025. However, the graphs below illustrate periods where bonds index had an annual return of around 25% with an annual volatility of around 10% as in end of May 2013. And, conversely, the S&P 500 had annual returns of around 1% in some periods, like October 2019, July 2026, November 2015, and others, with a volatility of around 16%. Slide number 12. Stock market's evolution experience ups and downs. These movements can be explained primarily by the law of supply and demand. When companies are expected to generate profits, the demand for their shares increase, requests for buying orders increase, more investors want to buy, so shareholders can sell their stocks at a higher prices. As long as these expectations are supported by solid economic and business data, the market tends to maintain an upward trend. However, if some disruptive event occur or when companies' valuation become less optimistic or even losses appear, stocks supply increase, requests for selling orders increase, more investors want to sell, and prices fall to attract buyers to purchase those stocks. Additionally, there is another explanation for short-term downward movements: the profit-taking. After a price upward period, investors tend to realize profits by closing their positions, and these decisions increase the supply of stocks, pushing prices down. Between 1957 to 1969, the general trend of the S&P 500 was upward, although there were some drops in price. In the second part of 1957, first half of 1962 and much of 1966, however, nothing comparable with the roller coaster of the next decade. The 1970s were marked by the oil crisis that cut short the promising first 3 years of the decade. The term blue chip refers to companies that are emblematic due to their weight in the economy and their sound evolution. The subsequent economic situation of recession and rising inflation, known as stagflation, hampered the evolution of the markets, which had a positive performance from the floor of the market prices in October 1974, but not without difficulties. Slide number 13. The 80s decade was overall very good, but after a fueled first 3 quarters of 1987, market exploited in one day. October 1987 Black Monday. On the 19th of October 1987, global stock markets, led by the US S&P 500 and Dow Jones Industrial Average, suffered an unprecedented one-day collapse. The S&P 500 fell about 20%, and the Dow Jones dropped 22.6% in a single trading session, the largest one-day percentage fall in U.S. history. The main causes were computerized trading, program trading. New automated trading systems at the time used portfolio insurance strategies, algorithms that sold stock index futures when prices began to fall, to limit losses. Unfortunately, when many funds did this simultaneously, it triggered a feedback loop of massive sell orders, accelerating the crash. Overvaluation and investor euphoria. Stock prices had surged by more than 40% in the first 9 months of 1987, creating unsustainable valuations and setting the stage for a correction. Interest rate and inflation fears. rising U.S. interest rates and concerns about inflation and trade deficits made investors nervous in the weeks leading up to the crash. Global contagion. As markets were becoming more interconnected, the panic quickly spread worldwide. London, Hong Kong, and other exchanges also collapsed in the following days. Despite the crash, the U.S. economy did not fall into recession, and markets mostly recovered in 2 years. The event led to major regulatory reforms, including the introduction of circuit breakers, temporary halts to trading when prices fall too fast, better coordination among global exchanges, and improvements in risk management for automated trading systems. The following 12 years, 1990 to 2002, began with gradual and steady growth, until the mid-90s when the internet usage and tech companies led to a boom in stock prices known as the dot-com bubble. The bubble burst began the 23rd of March 2000 when the year's high was reached 1,527. By the end of the 2000, the S&P 500 lost 14% while in the previous year had gained 18.5%. By the end of 2001, another 13% of annual lost, and by the end of 2002 another minus 23%. By the 9th of October the loss was 32% from previous December. December 2003 ended with a gain of 26%. From 2004 to October 2007, the S&P 500 evolved, speeding up until the highest on the 9th of October, 1,565, with a 10% increase from previous December and, curiously, the same day as the previous peak, the 9th of October, 2002, what meant an increase of 101% in 5 years. From October 2007 the financial crisis began. The main cause was excessive speculation on property values by both homeowners and financial institutions. Banks used the so-called mortgage-backed securities to fund their mortgage activities. Supposedly, these securities offer the investor a collateral to reduce relying only in the issuer, but when the market realized that those collaterals, mortgages of house buyers, were not as good collateral, the market burst, and bank bankruptcies began. The first one was the iconic Lehman Brothers in September 2008. In other markets the effects were similar, and in some cases it happened later and with higher impacts. Greece was near to default, and there was a consolidation of banks worldwide that led to a decrease in the number of banks. A stricter regulation was implemented for risk management and capital requirements for all banks, and closer monitoring of banks' situation, testing how to respond to bank crisis by central banks and regulators, recovery and resolution plans, which helped to stabilize the financial system. From 2009 the S&P 500 initiated a long positive evolution, whose tendency is known as bull market. In contrast, negative evolution is called bear market. This trend was not without its more or less prolonged corrections. Let's highlight the one that occurred in the last quarter of 2018, when the S&P 500 fell 20%. Main drivers were U.S. Federal Reserve rate hikes. The Fed raised interest rates 4 times in 2018, bringing the federal funds rate to its highest level since 2008. Investors feared that tighter monetary policy would slow economic growth and reduce corporate profits. Trade war with China, escalating U.S. China trade tensions, including new tariffs on hundreds of billions in goods, created uncertainty for global supply chains and corporate earnings. Global growth slowdown. Economic indicators began to weaken in Europe and China, fueling fears of a global slowdown. Overvaluation and profit-taking. After a strong rally in 2017 and early 2018, stocks were considered expensive. Many investors took profits amid the growing uncertainty. December liquidity panic. Late in the year, thin holiday trading amplified volatility. Comments from the Fed suggesting rate hikes would continue in 2019 triggered a rapid sell-off, the worst December for stocks since the Great Depression. Aftermath. The S&P 500 rebounded quickly in early 2019 after the Fed signaled it would pause rate hikes, calming markets. The episode became known as the Fed communication shock, a reminder of how sensitive markets are to monetary policy signals. Slide number 14. The 20s are being a roller coaster market. It began with a bull market continuing the 2019 evolution, until the 19th of February, 2020, where the signs of the pandemic consequences started appearing. In a month, March the 23rd, the S&P suffered a drop of 34%, but it didn't last, and before end of August it was above the 19th of February. By the end of the year the market increased 68% from the bottom of the year and 11% from February the 19th. A second drop happened in 2022. From the beginning of the year the S&P 500 fell with significant ups and downs until mid-October, with a drop of 25%. This was due to the supply chain disruption, but not only. Here the main factors that explain that evolution. 1. Post-pandemic supply chain disruptions. China's strict COVID lockdowns, especially in Shanghai and Shenzhen, caused massive delays in manufacturing and shipping. Shortages of components, notably semiconductors, disrupted global production, especially for automotive and tech companies, leading to reduced profits and higher prices worldwide. 2. Inflation surge. These disruptions, combined with high energy and food prices, pushed U.S. inflation to 9.1% in June 2022, its highest in 4 decades. 3. Aggressive Federal Reserve rate hikes. The Fed responded with rapid interest rate increases, from near 0% to near 4%, sharply tightening financial conditions and hurting high-growth sectors. 4. Russia-Ukraine war. The invasion in February 2022 spiked oil, gas, and grain prices, intensifying inflation and global instability. 5. End of stimulus and rising recession fears. As fiscal stimulus faded and borrowing costs rose, investor confidence dropped. Markets feared the Fed's tightening would push the economy into recession. Since mid-October, the S&P took an upwards path until end of 2024, with gains of 26% in 2023 and 24% in 2024. The S&P was still up 4% at the beginning of 2025, but in mid-February, U.S. President Donald Trump's announcement of a tariff review sent the market reeling. This decline continued into April with a loss of 19%. However, by September, the S&P had recovered 30%, reaching a new all-time high. Slide number 15. The previous 4 slides have shown the evolution of the world's most important stock market. How its rises and falls evolved is specific to this market, reflecting the economy it represents, the largest, and until today, the most innovative and productive in the world. Other markets tend to react in similar ways, though often with some delay and at a slower pace. Now, let's step back and summarize what these movements teach us about how markets behave. First, markets move daily because millions of investors make decisions at the same time, some buying, some selling, based on what they believe about future growth, inflation, or profits. When investors with better information or stronger conviction start acting, others tend to follow. That's how trends emerge, not from certainty, but from collective belief. Prices reflect not only company fundamentals, but also emotions. Fear and optimism are powerful market forces, sometimes even stronger than data. This is why, during crises, prices may fall faster than the fundamentals justify, and why bubbles form when optimism takes over. Over the short term, markets are noisy and volatile, full of short bursts of gains and losses. But in the long term, they usually reflect economic growth, productivity, and innovation. That's why investors who stay invested tend to benefit more than those trying to jump in and out of the market. Liquidity, the ability to buy or sell quickly, is another key feature. It allows investors to adjust their portfolios easily, and it's one of the main reasons markets are so efficient today. And remember, no one can consistently predict where markets will go next. All known information is already built into current prices, meaning success depends more on discipline and diversification than on timing. Diversification is essential because individual securities can fail. By spreading investments across different companies, sectors, or regions, you reduce the impact of one bad performer and increase your chances of stable growth. And when markets drop, recovering from losses requires even higher returns. For instance, losing 50% of your capital means you'll need a 100% gain just to get back to where you started. That's why controlling risk matters more than chasing returns. Finally, remember the golden rule: past performance doesn't guarantee future results. Markets evolve, economies change, and what worked in one period might not in another. Some new concepts have appeared in this slide or have been mentioned. Don't worry, we'll explore and explain each of them in the next slides. Slide number 16. Let's dig deeper and demonstrate why a larger profit is necessary in a market crash. We'll start by calling VT the new value of our portfolio after suffering a loss of L%, as shown in the first formula. Next, we need to calculate the required increase, R%, that would allow our portfolio to recover its value V0. This relationship is expressed mathematically in the second formula. By substituting the expression Vt from the first formula above into the second formula, we obtain the following equation. Notice that V0 appears on both sides, so we can divide them by V0 to simplify it as follows. This leaves us with a clearer expression showing that the larger the loss, L%, the greater the gain, R%, required to recover to the starting point. Finally, by rearranging the equation, we can isolate R% and express it as a function of L%. The intuition behind this is simple: after a loss, the base value becomes smaller, so any gain is calculated on a lower new base value than the one the loss was applied to. The lower the base, the harder it is to climb back. The graph illustrates the required gains need to be higher to recover from the increasing losses of 5%, 15% and 25%. In the previous slide, we noted that recovering from a 50% loss requires a 100% gain to return to the starting value. Slide number 17. 4 patterns tend: overconfidence, weak regulation, excessive leverage, and misunderstood innovation, appear before major market crashes to a greater or lesser extent, but certainly not insignificantly. Overconfidence: investors become convinced that prices will not fall, often supported by what seem to be solid arguments at the time. This has happened throughout the history. In the 17th century, the tulip mania, when tulips were seen as unique pieces that everyone desired, or previously to the Great Depression, when investors believed the new industrial era guaranteed unstoppable growth. or in the 1980s when the new methods for valuing options created the illusion that losses could be avoided. Or during the dot-com bubble when the internet was the panacea, and finally in the financial crisis of 2008 when most believed that housing prices could never fall because everyone needs a house. Lack of appropriate regulation. In each of the cases presented in the slide, regulators failed to foresee weakness that could have limited or prevented the crisis, whether due to early stages markets, new economic environments, new functionalities, or unfamiliar financial innovation. Excessive debt. Debt amplifies the crashes, whether held by investors, banks or governments, because magnify both gains and losses when conditions change. Innovation or products not fully understood. New financial or economic innovations are often adopted before their risks are completely understood, from tulips valuations, option hedging strategies, to complex mortgage-backed securities. Market participants underestimated how these innovations could unravel under stress. Slide number 18. Investment risks versus inflation certainty. In the previous slides, we warned you about the fluctuations your financial investments will undergo, but unlike these, inflation isn't a risk, it's a certainty. We are sure to experience it to a greater or lesser extent. It's the silent loss of value of money. When only periods of falling prices are considered, especially if they are pronounced, the consequences of inflation are more painful as losses increase. Being protected against inflation is one of the most important reasons to start investing consistently, systematically, and as early as possible. There is no other effective way to preserve your purchasing power over time. Perhaps 68 years may seem like a very long period, but losses are also significant over shorter horizons, around 51% over the last 30 years, 26% over the last 10 years and 17% in just 5 years. The only real way to combat inflation is to invest wisely. Slide number 19. This slide brings together several practical tips to make the most of what we've discussed so far: compounding, saving, and the long-term mindset behind investing. First, automate your savings. Think of saving as paying your future self first. By setting up automatic transfers to an investment account right after your salary arrives, you take emotion out of the decision. The money never stays in your checking account long enough to tempt you. This simple trick is one of the biggest differences between people who save consistently and those who always intend to, but don't. Second, cut unnecessary expenses. Small recurring costs, unused subscriptions, impulse purchases, premium services you barely use, are silent wealth destroyers. Creating a simple budget, even a monthly review, helps you redirect those amounts to investments where they'll grow through compounding. Remember, every euro saved today is a worker you send out to earn for you tomorrow. Third, increase your income whenever possible. We often focus on saving more, but earning more expands the potential dramatically. Use your skills, teaching, consulting, repairing, designing, to create small additional income streams. Even modest side income, if invested regularly, can have a large impact over time. Next, the emotional side. Market downturns are inevitable. Don't panic when they arrive. History shows that markets recover, but only for those who remain invested. Reacting to short-term drops is one of the main reasons investors underperform their own investments. Patience and discipline beat constant adjustments. And of course, reinvest your returns. This is the essence of compounding. When your interest or dividends generate new returns themselves, your wealth accelerates exponentially. Compounding is not magic, it's mathematics combined with time and consistency. Now, at the bottom of the slide, you see the three elements of every portfolio: time, savings, and return. You control the first two, time and how much you save. The third, the market return, is not in your hands. So focus your energy on what you can actually manage, starting early and contributing regularly. The formula on the right shows this mathematically. Your portfolio grows by savings multiplied by return and time, but time is the most powerful of the three. The shorter your horizon, the more you'll need to compensate by saving more aggressively. So, to sum up, automate your savings, control your expenses, look for ways to grow your income, stay calm during downturns, and let time and compounding do their job. Investing is not about timing the market, it's about time in the market. Slide number 20. Remember the swindler's offers. In slide 4. Let's break down the concept and uncover how it really works. Let's unpack the idea and see what's behind it. Slide number 21. Let's go through a bit of financial mathematics, step by step. The first equation was already introduced in slide 19. Now, we'll break it down into smaller parts to distinguish between the interest earned on the initial capital and the interest earned on the accumulated interest, in other words, to see how money starts working for you. In the first year, when t equals 1, we only earn interest on the initial capital, that is, V multiplied by R. In the second year, since the interest from the first year is reinvested, the final amount V will be the initial capital V plus the interest gained over 2 years, 2 multiplied V multiplied R, plus the interest earned on the previous interest from the first year, V multiplied R multiplied R. From there, formula 1 can be rewritten and split into two parts, allowing us to determine the number of years required to double the initial capital, and the number of years for compounding interest to surpass simple interest. Slide number 22. Years for doubling the capital and for interest on interest to exceed interest on capital. This slide presents two very practical rules of thumb that help us quickly estimate how our money grows, without needing a calculator. The first rule tells us how long it takes to double our capital. It's known as the rule of 72. You simply divide 72 by the annual rate of return expressed as a percentage. For instance, at a 6% return, 72 divided by 6 gives 12, meaning your capital doubles roughly every 12 years. Of course, this is just an approximation, but as shown in the chart, it stays remarkably accurate for moderate interest rates between about 4% and 12%. The second rule helps us understand when compounding starts outperforming simple interest. It gives the number of years required for the interest on interest to exceed the interest on the original capital. The approximate formula here is 1.256 divided by the rate squared, so again, a higher rate makes this happen sooner. For example, at 5%, this point occurs after about 5 years, that's when your money truly begins working for you. The three charts at the bottom illustrate this transition. At first, both simple and compound interest lines move almost together, but after a few years, the compounding curve starts to bend upward, showing that growth is accelerating. The takeaway here is that compounding needs time to show its full power. It doesn't make much difference in the short term, but the effect becomes exponential as the years pass. Slide number 23. Compounding refers to the process where your savings start working for you. They generate returns, and if those returns stay invested, they generate additional returns. In other words, your money earns returns on returns. And that's why time becomes the most important factor. At the beginning, the effect looks small, barely noticeable. But as time goes on, it accelerates, just like a snowball rolling downhill. Let's look at what that means in numbers. If you save €10,000 per year at 5%, after 25 years you'll have about €511,000. But starting with just €10,000 more upfront grows the result by €36,000, that's plus 7%. That's the snowball effect in action. Your early capital starts earning for you immediately. Now, if you delay your savings by just 5 years, you lose precious compounding time. The result drops by €154,000, or minus 30%. To make up for that delay, you'd need to save about 43% more every year, roughly €4,300 extra. Even adding a modest initial saving later, say, €10,000 upfront, helps, increasing your final value by about €28,000, or plus 8%. But if you delay and also skip that initial saving, the cost is heavy. You end up with about €162,000 less, or minus 29.6%. This is why we say compounding rewards patience. The longer your money stays invested, the harder it works for you. In the short term, growth feels slow, but over time, the reinvested earnings start generating their own earnings, and that's when the acceleration really begins. So, stay invested, stay consistent, and let time do its job. Slide number 24. This slide illustrates one side of the trade-off between the investment horizon and the size of savings. Assuming an average rate of return over time, it shows how increasing annual savings shortens the time needed to reach a target amount. In the example shown, with a 5% annual return, every additional 2.5% of income saved reduces the investment horizon by roughly 2 years. This demonstrates that, presuming a rate of return, saving more each year is one way to reach your goal faster. Of course, there's a limit to this effect. Doubling your savings doesn't mean halving the time, but it highlights how the savings rate is one of the few levers truly under your control. That brings us to the other side of the trade-off. If you can't increase your savings, then you must start investing earlier. Let's move to the next slide, when to begin investing, where we'll see how starting early can compensate for smaller savings, thanks to the power of compounding over time. Slide number 25. In the previous slide, we saw how saving more each year can shorten the investment horizon. But not always is possible to increase the savings. Luckily, there is another equally powerful lever, time. This slide illustrates how the moment you start investing changes everything. Here, the goal is the same in all cases, reaching €500,000 by the age of 65, assuming a 6% annual return. The only difference is when you begin. Someone who starts at age 25 needs to invest just under €49,000 as an initial lump sum. But if they wait until 40 to begin, they'll need almost €117,000. That's about 1.4 times more money, to reach exactly the same target. The reason is compounding. The longer your money stays invested, the more time it has to earn returns on top of returns. Each year you delay, you lose one cycle of growth, and those missing cycles multiply over time. So, if you can't increase how much you save, the best strategy is simple: start earlier. Time is your greatest ally in investing, and once lost, only could be recovered substituting it with more money. The same principle also applies when saving regularly. The earlier you begin, even with smaller contributions, the more powerful the compounding effect becomes. Slide number 27. Now that we've seen how savings and time affect investment results, let's move to another essential concept: return and risk, often called volatility. On the left, we have return, which is simply the profit or loss from an investment, expressed as a percentage of what we initially put in. But returns should always be interpreted in context. They depend not only on the initial amount but also on how long it took to achieve them and whether they include income like dividends or coupons, minus any fees. In this example, Anne and Lawrence both invested €1,000 but at different times. After some months, Anne's investment is worth €1,055, while Lawrence's is worth €1,045. That difference in final value leads to different annualized returns, 5.5% for Anne and 4.5% for Lawrence. Notice that even though the time periods are similar, a small change in return compounds into a noticeable difference when extended over years. Now, on the right, we have risk, or more precisely, volatility. Volatility measures how much returns fluctuate over time. It's like the bumpiness of your investment journey. If you look at the top picture, a calm lake symbolizes low volatility, smooth, predictable movements where prices don't change much. The bottom image, a roller coaster, represents high volatility, strong ups and downs that can be thrilling but also stressful. In simple terms, the higher the volatility, the more uncertain your results will be in the short term. But high volatility assets, like stocks, often offer higher long-term returns as a reward for taking that risk. This balance, between seeking returns and managing volatility, is at the heart of all investment strategies. Understanding it helps us build portfolios that match our goals and, most importantly, our ability to tolerate risk. Slide number 28. On the previous slide, we defined return as the average performance of an investment and volatility as how much that performance fluctuates. Now, let's visualize how both interact through simulated market scenarios. Each of these charts shows the evolution of 1,800 simulated portfolios, all starting at the same initial value, 100, and evolving daily over 20 years. We start here with the top group of charts, showing portfolios with an average annual return of 3% and low volatility, sigma equals 5%. You can see that most lines evolve smoothly, ending around 150 to 200 after 20 years. Losses below the starting value are extremely rare, less than 1% of all cases. The middle graph confirms this stability. Returns fluctuate but remain concentrated around the 3% average. Now, look at the bottom. Here, we've kept the same average return, still 3%, but increased volatility to 15%. Immediately, you can see a huge difference. Some portfolios explode upward, reaching 1,000, while others decline drastically, even below their initial value. The middle chart shows why, with high volatility, some years deliver exceptional performance, others deep losses. Over 20 years, around 20% of portfolios actually end up below the starting value. This is the key takeaway: with higher volatility, even if the average return remains the same, the range of possible outcomes becomes much wider. You may earn much more, or you may lose, because the ride becomes bumpier. Slide number 29. Now, let's repeat the same experiment but with a higher expected return, 7% per year. The top scenarios show low volatility, sigma equals 5%. The portfolios rise steadily, smoother, more predictable growth, and none of the 1,800 cases end below the starting point. This is the kind of long-term trend we would expect from a well-diversified portfolio with stable returns. On the bottom, the volatility is increased again to 15%. Notice how the spread of outcomes expands dramatically. Some simulations end below 100, while others reach well above 2000. The average is still around 7%, but the uncertainty is much greater. The central and right-hand charts highlight this difference clearly. Higher volatility amplifies both gains and losses. It doesn't change the mean, but it changes your experience as an investor. So, comparing all four simulations, 3% versus 7% returns, each with 5% and 15% volatility, we can see the essence of risk-return trade-off. Higher expected return compensates for higher risk. Slide number 30. On the previous slides, we saw thousands of simulated price paths under different return and volatility assumptions. The message was clear: volatility doesn't change the average return, but it greatly affects how wide the outcomes can be. Now, this slide summarizes those ideas in a single image using normal distributions. Each curve represents how likely different returns are for an asset. The center of the curve is the average return, and the width of the curve depends on volatility. The first chart at the top compares two assets. Asset A, shown in blue, with a return of 5% and a volatility of 7%. Asset B, in red, with a return of 12% and a volatility of 15%. Notice how Asset A's curve is narrower and taller, meaning its returns are more predictable, but they stay close to the average. By contrast, Asset B's curve is wider and flatter, showing that returns could deviate much more from the mean, both positively and negatively. In the two graphs below, you can see the same logic in isolation. The left one shows Asset A. Most outcomes fall between 2% and plus 12%, with a small but real chance of finishing negative. The right one shows Asset B, results spread from plus 3% to plus 34%, much more uncertainty, but also greater upside potential. So, while Asset A offers lower variability, its expected return may not be sufficient to offset the risk of a small loss. Asset B, on the other hand, carries a higher risk, but it also rewards investors who can tolerate that volatility with the potential for significantly higher gains. In essence, this visualization explains the risk-return trade-off. Higher volatility means wider outcomes. Wider outcomes mean both greater opportunity and greater uncertainty. In a later slide, we'll explore how investors can manage this trade-off, staying exposed to returns while limiting downside risk through diversification. Slide number 31. Up to this point, we've seen that different combinations of returns and volatilities can produce very different outcomes, some smooth and predictable, others volatile and uncertain. If we look back at the simulations, we saw that portfolios with low returns and high volatility, such as 3% with sigma equals 15%, resulted in many losing scenarios. More than 20% of them actually ended below the initial value. Meanwhile, portfolios with possible higher returns, like 7% or 10%, even with higher volatility, ended much more often in positive territory. So, the natural question is, how do we compare different investments, not just by return, but by how much risk we had to take to get it? That's where the Sharpe ratio comes in. It's one of the most widely used measures in finance to evaluate the risk-adjusted performance of an investment. In simple terms, it tells us how much excess return an investment delivers for each unit of risk taken. The formula is shown here. We subtract the risk-free rate, which represents an almost guaranteed return, such as short-term government bonds, from the portfolio's return, and divide the result by the volatility, which measures how variable those returns are. So, the numerator represents the reward, how much more the investment earns than a risk-free alternative. The denominator represents the risk, how unstable that return is. The higher the Sharpe ratio, the better the compensation you're getting for the volatility you endure. At the bottom, you can see that a portfolio with 3% return and 5% volatility has a Sharpe ratio of about 0.20. Increasing the return to 7% with the same volatility gives 1.00. And at 10% return, the Sharpe ratio rises to 1.60. However, when volatility Slide number 32. This table summarizes the results of our 4 simulated portfolios, combining different returns and volatilities. We can see in the first 2 columns the combinations of expected return, mu, and risk, or volatility, sigma, followed by the number of loss scenarios observed among the 1,800 simulations. Then we have the average minimum and maximum results, the range, which gives a sense of dispersion, and finally the Sharpe ratio, which measures efficiency, return per unit of risk. Starting with the 3% return portfolios, we can already see a striking difference. With low volatility, 5%, the Sharpe ratio is 0.20, which is modest but still positive. However, when volatility rises to 15%, the Sharpe ratio collapses to 0.07, meaning that the extra risk brought almost no additional reward. In fact, 365 of the 1,800 scenarios ended with a loss. Moving to the 7% return portfolios, we see a much better profile. With 5% volatility, the Sharpe ratio is exactly 1.0, considered a good risk-adjusted return in practice. Even when volatility triples to 15%, the Sharpe drops to 0.33 but still delivers a positive excess return relative to the risk taken. Finally, at the 10% return level, we see Sharpe ratios of 1.6 and 0.53, both strong, meaning that these portfolios deliver significantly better compensation for volatility, especially the one with lower risk. On the right side, the interpretation table helps put these numbers into perspective. A Sharpe around 1 is considered good. Around 2 is very good. Around 3 is excellent, though rarely achieved in real markets. Below 1, however, the investment isn't very attractive compared with risk-free alternatives. From these results, several lessons emerge. Higher volatility can indeed increase the range of possible outcomes, both gains and losses. Higher returns can offset higher volatility, but only up to a point. Portfolios that combine low returns and high volatility are typically inefficient, often the result of poor investment design or mismanagement. And finally, although higher volatility is often associated with higher returns, in the real world, this relationship isn't guaranteed. That's why professional investors constantly seek the right balance, maximizing return for each unit of risk, rather than simply chasing performance. Slide number 34. On this slide, we explore the concept of when returns occur during the investment journey, whether they come early or late in time. Let's imagine 3 investors, the early bird, the steady bird, and the late bird. They all invest the same amount each year, in this example, €4,800 annually, and over the full horizon, all 3 achieve the same average annual return of 6%. But what differs is when the higher or lower returns appear. The early bird earns strong returns in the first years, around 14% initially, but only 1% in the final phase. The late bird, on the other hand, experiences the opposite, modest returns at first, but much higher ones near the end of the period. The steady bird keeps a consistent 6% return every year. Looking at the top chart, which represents a 50-year horizon, you can see how these timing patterns produce very different results, even with the same average rate. The late bird, benefiting from high returns when the portfolio is already large, ends up with a final value of about €2.8 million, compared to just €944,000 for the early bird. Why does this happen? Because high returns on a small portfolio, like those of the early bird in the beginning, don't have much impact. But high returns on a large portfolio, as in the late bird case, multiply the value dramatically through compounding. If we look at the second graph, the 20-year version, a more reasonable horizon, we see the same principle on a smaller scale. Again, the late bird ends ahead, and the early bird lags behind, even though their average annual returns are identical. This highlights a crucial insight for long-term investors: the timing of returns matters. The same average return can produce very different outcomes depending on when the strong years occur. From a portfolio management perspective, this idea becomes particularly important as we approach the end of the investment horizon. During the final years, it's usually better to reduce volatility, that is, take fewer risks, to protect the capital already accumulated, because a negative return late in the horizon can undo years of growth. So, in essence, being an early bird in taking risk is beneficial, but being a late bird in earning strong returns, when the portfolio is largest, is what really makes compounding powerful. And this balance between risk timing and return stability is at the heart of investment horizon management. So, which strategy is better, being an early bird or a late bird? Mathematically, the late bird seems more attractive, because high returns earned when the portfolio is large have a much stronger compounding effect. But in practice, it's a risky bet, since no one can guarantee strong returns at the end of the horizon. The more prudent and realistic approach is to take higher risks early, when there's still time to recover from market drops, and reduce volatility gradually as the portfolio grows. In other words, start like an early bird to build momentum, and finish like a steady bird to protect what you've built. That balance, risk early, stability later, is what truly makes long-term investing sustainable and effective. We'll come back to this idea later. Slide number 35. Now that we've seen how risk and returns interact, the next question is, how can we manage that risk without giving up returns? Or in other words, can we reduce risks? The answer lies in diversification, one of the most fundamental principles in investing. Every investment, whether it's a stock, a bond, or real estate, goes through cycles of ups and downs. These fluctuations are inevitable. However, not all assets move together. For example, when stock markets fall, bond prices often rise. Or when one sector of the economy slows down, another might be expanding. This difference in behavior is what diversification takes advantage of. By spreading investments across different types of assets, sectors, or even regions, you can balance losses in some areas with gains in others. The key concept behind diversification is something called correlation, which measures how two assets move relative to each other. If they move in the same direction, their correlation is positive. If they move in opposite directions, the correlation is negative. Combining assets with low or negative correlation helps to smooth out portfolio performance. It doesn't eliminate risk, no strategy does, but it makes returns more stable and predictable over time. This stability is essential for compounding to work effectively. When volatility is reduced, you avoid deep losses that take years to recover from, and your portfolio keeps growing more consistently. In other words, diversification is about not putting all your eggs in one basket, and more importantly, about choosing baskets that don't all break at the same time. Slide number 36. In this slide, we can actually see diversification in action. Charts show two individual assets, represented in navy blue S1 and light blue S2, and their combined portfolio in orange SP. Charts present different possible scenarios of prices evolution for S1 and S2. In the first graph, the assets have a fully positive correlation, +1. This means that they move in the same direction. When one rises, the other rises too, and when one falls, the other also tends to fall. As you can see, the portfolio does not benefit from diversification. The combined curve, orange, shows the same fluctuations, because both assets are exposed to similar movements. The volatility remains relatively high, at around 7%. Now, look at the graph in the right side, where the correlation is fully negative, -1. Here, when one asset moves up, the other often moves down, offsetting each other's movements. This has a compensation effect. The portfolio becomes much more stable. The combined curve is smoother, with smaller drawdowns during declines and a more consistent upward trend. Even though each individual asset still experiences volatility, the overall portfolio volatility drops to about 1.0%, while maintaining the same average return. When correlation is positive but less than perfect or full, 0 and -1 and 0, the offset is lower but still there is. This is the essence of diversification. It doesn't increase returns, but it significantly improves the risk-adjusted return, by reducing volatility and protecting against large losses. In practice, what we aim for is not just to hold different assets, but to hold assets that behave differently, ideally, with low or even negative correlation, so that when one is struggling, another is helping to stabilize the portfolio. Slide number 37. 1. Define goals. Be precise: amount, date, purpose. Goals determine horizon, liquidity needs, and acceptable drawdowns. 2. Assess risk tolerance. 2 lenses: ability, income stability, buffers, horizon. Willingness, your comfort with seeing 20% on screen without selling. Use the lower of the two to size risk. 3. Asset allocation. This is 80-90% of long-term outcomes. Map goals /risk to a target mix, for example, 70/30, 60/40. Keep cash only for runway /emergencies, otherwise, it loses to inflation. 4. Select investments. Default to broad, low-cost index funds /ETFs to capture beta efficiently. If adding active funds or factors, set a clear role, for example, small value tilt, quality, or M-debt, and position size, risk budget. Check total cost, total expense ratio, TER, plus trading and taxes, capacity, and tracking error. Avoid overlap that undoes diversification. 5. Diversify. Spread across regions, sectors, styles, value /growth, and bond types /durations. Prefer low or negative correlations to smooth the ride. 6. Adjust portfolio, rebalancing and changes. Rebalance to targets on a schedule, for example, semi-annual, or with bands, for example, ±5p.p around target. This forces sell high /buy low and controls risk drift. Adjust only for material changes, life events, income shift, house purchase, updated goals, or sustained regime shifts, for example, term structure, tax rules. Document any change: what, why, risk impact, costs. If you can't write it in 2 sentences, don't do it. 7. Timing decisions. Market timing is a tax on performance. Use automation, monthly contributions, DCA, and rules-based rebalancing. Only time the market for extreme, predefined cases, for example, after-tax cash flows or lump sum inflows. 8. Monitor performance. Track 3 simple metrics quarterly: return versus benchmark, volatility /drawdown, and tracking to goals, funding ratio or wealth versus plan. Focus on process KPIs, contribution rate, adherence to bands, cost control, not short-term wins. If you're reacting to headlines, you're monitoring too often. If you never notice drift, not often enough. Quarterly is a good default. Key message: goals, risk allocation, diversification, low-cost implementation, disciplined rebalancing, periodic review. That pipeline, done consistently, beats ad hoc stock picking and market timing over the long run. Slide number 38. Now that we've discussed the early bird and late bird approaches, this slide brings that concept into a structured investment framework, what we call a glide path. A glide path defines how the risk level of a portfolio evolves over time, usually from high risk when we start investing, to lower risk as we approach our goal, such as retirement. Let's recall the key insight from the early or late returns slide. Losses on a small portfolio early in the journey are less harmful, because there's time to recover. But once the portfolio has grown, even small losses can erase a significant part of the accumulated wealth. That's why, in the early years, investors can afford to take more risk, aiming for higher returns while the invested capital is still small. As time goes by and the portfolio becomes larger, the strategy gradually shifts, risk is reduced to protect what's been accumulated. That's what we mean by gliding smoothly toward the investment horizon. The portfolio transitions from growth-focused to preservation-focused. The chart below illustrates several possible glide paths: linear, exponential, logistic, and others. Each line represents how the proportion of risky assets, such as equities, decreases over time. The choice of curve depends on the investor's risk aversion and time horizon. In practice, this means that younger investors might have a portfolio with 80 to 90% in equities, while approaching retirement, that share could fall to 30 or 40%. In summary, the glide path provides a disciplined way to manage risk dynamically, taking it when it matters most, early, and protecting capital when it matters more, later. It's the bridge between theory and action in long-term investment planning. Slide number 39. This slide brings us to one of the most practical questions in personal finance: how much do I need to save to retire comfortably? To answer that, several key elements must be considered. First, your annual expenses during retirement, that's the base of your needs. Then, any secured income, such as pensions, annuities, or rental income, must be subtracted to determine your net annual needs, the amount you'll actually need to finance from your savings or portfolio. Next, we must define the retirement age and the life expectancy, which together determine the number of years the portfolio must sustain withdrawals. And finally, we must estimate both inflation and expected portfolio returns, since these two variables will determine how your savings grow and how far they stretch in real terms. The formula shown here calculates the present value of a growing annuity, essentially, the amount of capital required at retirement to sustain a given annual withdrawal that grows with inflation. For example, assuming an annual need of €20,000 during retirement, a 5% return, and 3% inflation. For 25 years, you would need around €381,700 at the time of retirement. For 35 years, that increases to €489,900. The table shows how this factor changes depending on return and inflation levels. As you can see, even small changes in these parameters can make a significant difference in the required capital. Slide number 40. Let's analyze the most important investment in their lives for most people, buying their house. Should we use our savings to pay off the mortgage early, or instead to invest that money? Here is a practical example. We have a house priced at €450,000, with 20% down payment and a 30-year mortgage at 3% interest. With a gross salary of €55,000, after taxes and expenses, the investor can save around 10% of their net income, about €3,700 per year. The table compares two strategies. No pre-amortizing, where savings are invested monthly in an index fund. Pre-amortizing, where those savings are instead used to pay down the mortgage early. Looking at the results, by prepaying the mortgage, the interest cost falls from €221,000 to €169,000, a clear saving of €52,000. The loan term is also shortened by more than 6 years. However, during those same years, investing the savings rather than prepaying generates a portfolio of around €261,000, versus only €29,000 in the pre-amortizing scenario. That difference in investment value, driven by compounding, largely offsets the mortgage interest saved. So even if the investment return is slightly below the mortgage rate, it can still be financially more advantageous not to pre-amortize, because the invested amount grows over time through compound returns. However, financial reasoning is only one side of the equation. From a personal and risk perspective, paying off the house early has its own advantages. It gives peace of mind, ensures stability in case of job loss or unforeseen events, and allows future leverage if you ever decide to use the home's equity for another investment. Of course, this last point, borrowing again on a paid property, introduces additional risk and must be carefully considered. In short, financially, investing the savings is often the better option thanks to compounding. But from a risk management and psychological standpoint, having your home fully paid off is often the more comfortable and safer path.